You've probably heard this for months now. Interest rates are coming down. We've been told the Bank of Canada is going to ease, relief is coming, a break is just around the corner. But here's the curveball. Some of Canada's biggest banks are now saying the exact opposite. Not only are they taking those predicted rate cuts off the table, they're actually saying rate hikes might be back. Yes, hikes. Now, this isn't some clickbait headline I'm throwing out there to scare you. This is coming directly from the latest market data, inflation numbers, and statements from major banks like RBC, Scotiabank, and Desjardins. And if you own a home, have a mortgage renewal coming up, or you're thinking about buying in the next year, this hits your budget hard. Let's rewind just 60 days. Back then, the market was pricing in up to 3 rate cuts in 2025. Some predictions had the overnight rate dropping all the way down to 2%. That's 0.75% lower than where we're sitting today. And in mortgage terms, that's a lot of breathing room. Fast forward to now, core inflation, which is the Bank of Canada's preferred measure because it stripes out all volatile things like food and energy, just came in at 3.4%. That's well above the Bank of Canada's 2% target. And economists say that if we hit 3.5%, a rate hike might become more likely than a cut. Think of that 2% target like the Bank of Canada's check engine light. When inflation is above that, it's telling them that the economy is running too hot. And when that check engine light starts flashing, the Bank of Canada usually moves to rise interest rates, not lower them. Now, here's where it gets even more real. Bond yields, which directly influence fixed rates, just crossed the 3% mark. That's a threshold lenders and economists have been watching closely. The moment we crossed it, banks started quietly nudging rates up by 0.1 to 0.25%. Now, I understand that that is not a massive jump yet, but it's the first reversal we've seen in months. And it's a signal that the easy downward trend we have been hoping for might be on pause. On top of that, Scotiabank and Desjardins are now openly warning that rate hikes this fall are possible. Not guaranteed, but they are possible. And in mortgage terms, possible is enough to make you take action now if you're smart about your money. But here's the thing. If you're buying a home without the proper rate hold in place, or if your mortgage is coming up for renewal in the next 6 to 12 months, this shift could cost you tens of thousands of dollars. And it's not just about interest rate. This kind of uncertainty ripples through the housing market. Sellers hold out for higher offers, buyers hesitate waiting for rates to drop, and in the middle, we've got this weird standoff where prices aren't really going up or going down, but the cost of borrowing is creeping higher. In the next part of this video, I'm going to break down exactly why the banks have flipped their forecast, how these inflation numbers are reshaping the housing market, and why this might be actually the most affordable moment to buy in certain cities, even if rates go up. But more importantly, I'm going to give you specific steps you can take right now to protect yourself from paying thousands more than you need to on your mortgage. Because if you think you can just wait it out, you might be in for a very expensive surprise. All right, so let's dig into why the banks have flipped their forecast and why this matters so much to you right now. Let's start with the inflation numbers. Headline inflation, that's the number you see in most news reports, just came in at 1.9% year over year. Now that sounds great. That's below the Bank of Canada's 2% target. But here's the catch. That number includes a temporary dip from the carbon tax rebate. If we stripe that out, real inflation number is actually 2.5%, and that's a problem. Now, why is that a problem? Because the Bank of Canada's job is to keep inflation at 2%. If we're sitting above that target, it tells them that the economy is still running hotter than they want. And that means the odds of rate cuts go way down and the possibility of rate hikes go way up. But the bigger number to watch, and the one the Bank of Canada cares about the most, is core inflation. Core inflation removes all of the most volatile items, things like gas and food prices. So it gives them a clearer picture of the underlying trends. That number just came in at 3.4%, the highest since April. And here's the scary part. If it ticks up to 3.5%, many economists say rate hikes become more likely than not. Think about it like this. Core inflation is the Bank of Canada's check engine light. Right now, it's blinking orange. If it goes up even a little, it turns red. And historically, that's when they start tightening policy. Now let's talk about how that's already showing up in the mortgage market. Bond yields, which are the foundation for fixed mortgage rates, have been rising. They've recently crossed the 3% mark, and that's a big deal. Why? Because once it hits that threshold, it becomes harder for banks to offer deep discounts on fixed rates. So what happened? Within days, lenders started bumping rates by anywhere from 0.1 to 0.25%. Now that's not a massive jump yet, but it's the first move in the wrong direction after months of gradual easing. And it tells us that the market expectations have shifted. So what does this mean if you're in the market for a home or if your renewal is coming up? It means that waiting for rates to magically drop might actually cost you more than acting now. And here's why. RBC recently put out a report saying that in many Canadian cities, this could actually be the most affordable moment to buy a home in the last 5 years. Yes, you heard that right. Even with rates where they are today. That's because in some regions, prices have softened just enough to offset the impact of higher rates. But this affordability window could close fast if rates climb even by just a little. The June housing market numbers tell a story. Nationally, the average home price was about $688,000, and that's flat compared to last year. But that number hides huge regional differences. Newfoundland, double-digit price growth. Parts of the Maritimes, same story. They had huge gains. Vancouver Island, still moving strong. But then we've got Fraser Valley. Prices are sliding. Toronto condo market, they're all down big time. Vancouver condos are also down. And this matters because condos are often the first step into the market for first-time home buyers. Falling condo prices can be a big thing for them, but there are headaches for investors who bought in the peak prices and now are looking to sell. Right now, we're in a strange stalemate. Buyers are sitting on the sidelines waiting for rate drops. Sellers aren't feeling enough pressure to drop their prices, so they're holding out for the numbers they want. Prices aren't surging, but they're not climbing either. It's a chess game and no one is making a move. Here's the thing. This wait and see approach might feel safe, but if bond yields keep climbing and lenders keep adjusting their rates upward, it's going to cost you real money. Let's talk about renewals first. If your mortgage is coming up for renewal in the next 6 to 12 months, you are currently somewhere in around 5% or higher. You need to start looking at your options now. And why? Because you can lock in a rate for up to 12 months in advance. That's called a rate hold. The smart move right now is to get a rate hold in place, and here's why. If rates drop before your renewal date, you can float down to the lower rate. If rates go up, you're protected at the lower rate you locked in. Win-win, but most Canadians don't know this is even possible. And that's going to cost people thousands of dollars. Here's a quick example. Let's say your renewal is in February, and you can lock in a rate today at 4.5%. If rates go up to 5% by then, you've saved yourself 0.5% over the next 5 years. That's tens of thousands of dollars in interest. If rates drop to 4%, you can still get the lower rate. Now let's talk refinancing. A lot of people refinance to consolidate debt or access equity for things like renovations and investments. But here's the danger. If rates go up and your property value dips, you could lose access to the equity altogether. If your home is worth $800,000 today and prices drop in your area by 5%, that's $40,000 in lost value. That could be the difference between qualifying for the amount you want and being forced to take a smaller mortgage or a line of credit. If you've got high interest debt, you were planning to consolidate, that could mean paying thousands more in interest over the next few years. Now for investors, this is the time to be ultra conservative with your numbers. Vacancy rates matter now more than ever, and cash flow should be your number one priority. In a shifting market, I'd be looking at shorter fixed terms, maybe a 3-year fixed, to give yourself flexibility to adjust when rates eventually settle down. And pay attention to where the yields are strongest. Right now, Alberta is outperforming Ontario in a lot of communities when it comes to rental returns. That's why we're seeing more investors looking west. And here's the bottom line. We're in a moment of uncertainty. Some banks are saying rate hikes could happen this fall. Bond yields are already rising. Correlation is stubbornly above target. If you're sitting on the sidelines waiting for the perfect moment, you might miss that window where you could lock into a better rate or bought a property before the cost goes higher. And remember, when rates move, they move fast. Bond yields can jump in a day, and lenders can adjust their mortgage rates within hours. By the time you hear about it in the news, it's often too late. So what can you do right now to protect yourself and even use this market to your advantage? First, if you're a buyer, if you're planning on buying a home in the next 5 to 10 years, don't sit on the sidelines waiting for rates to drop. Yes, I know it feels like the smart move to hold off until you can get a cheaper mortgage, but the reality is you might miss that window. RBC's data says we could be in the most affordable moment in the last 5 years for a lot of markets across Canada. That affordability is a mix of softer prices in some areas and the ability to actually negotiate. If you're buying right now, you have more leverage than you've had in years. You can be picky about the property, negotiate on price, negotiate on closing date, and even get conditions like a home inspection back on the table. Buying isn't just about interest rates today. It's about owning a property you want, in the area you want, for the long term. If the numbers work for you, you can always refinance later when rates drop. If you're renewing, and this is a big one, if your mortgage is coming up for renewal in the next 6 to 12 months, you must be proactive. Here's your move. Get a rate hold now. Most lenders will lock in a rate for up to 120 days. Some even a full year in advance if we structure it properly. If rates drop between now and your renewal date, you can float down to a lower rate. If they go up, you've locked into today's numbers. This literally is the easiest insurance policy you can give yourself against rising interest rates. And yet, most Canadians don't do it. I can't stress this enough. If you let your renewal just roll over without planning, you're almost guaranteed to pay more than you need to. Third, refinancing. If you're thinking about pulling equity out of your home, whether it's to consolidate high interest debt, fund a renovation, or invest, the time to explore your options is now. And here's why. If home values in your area drop, you might not qualify for the amount you want later. And if rates climb, the line of credit or new mortgage is going to cost you more. It's about locking in your access to your capital while equity is still there and before borrowing costs climb even further. Fourth, for investors. If you're in the rental market, this is the time to tighten up your numbers. Run your cash flow projections assuming higher interest rates and lower rent growth. Look at markets with stronger yields and lower vacancies. Right now, like Alberta is outperforming Ontario in many areas. And be afraid of shorter fixed rate mortgages. A 3-year term could give you the flexibility to adjust when rate cycles eventually turn. So takeaway, we're in a market where timing and preparation matters more than ever. You don't have to be scared of rate hikes, you just have to be strategic. If you're buying, use your leverage now. If you're renewing, lock in early. If you're refinancing, secure your equity while it's still available. If you're investing, run conservative numbers and stay flexible. The thing you can do right now is nothing. Waiting without a plan is not a strategy, it's a gamble. As we've seen, the markets can shift in a matter of days. By the time the headlines say rates are up, it's already too late to protect yourself. So take action today. Talk to your mortgage professional, get your numbers locked in, and put yourself in a position where rate hikes won't derail your plans. Because while the banks may have just changed everything, you still have the ability to make this market work for you and not against you. I'm Justin Chaussee, and I'll see you in the next video.